India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a fresh new week. It's a week from the 20th of January, President Trump's inauguration. It's about 3 weeks away from the union budget. But, you know, if you expected that there will be some calm before the storm, there is no calm before the storm. I mean, of course, we're calling 20th as the storm, not the budget. But there is no calm. In global markets, forex markets, bond markets, I mean, it's upheaval out there. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, morning, folks. Plenty of headlines and, you know, pretty difficult headlines to go over internationally. But I want to hold on to the silver lining. It's Monday. We have good data in the form of IIP here back at home. Yep. And, of course, this big Gala UP event, the Kumbh kicks off today. And, you know, religious tourism is becoming so huge. And you have a lot of the A-listers, Bollywood A-listers, Hollywood celebrities who are about to descend on Prayagraj. And I think that's the visuals of the first Snan as it comes through. So perhaps, I mean, in terms of being a major contributor to the state's economy and to putting, you know, India once again on the world map, this is definitely an event that the world is watching out for. A lot of infrastructure development has happened in the region. I have some family in that region as well. So the reports that I get from the ground is that some mega infrastructure development has been on for the last couple of days. We hope the event just goes off peacefully. It's a long one, all the way up to February. So hoping for the best. It's all eyes on UP.
I think this happens once in 10 years, right?
No,
so
this is the big one. This is the Mahakumbh. This is I think, once in over a century, I think. It's that one.
Oh, wow.
Yeah.
I mean, that's, Okay, all right.
All right, and very happy Lohri as well to all our viewers who are joining, and happy Lohri to both of you guys as well.
Absolutely.
You know, a special feeling. I mean, my in-laws as well will be celebrating it, so it's a big.
I can tell you, but Delhi Memories is a big festival up in the north. The time to be happy and sort of joyful and hopeful about the future as well.
Absolutely, and I think we've all kind of celebrated it being in Delhi, of course, for the majority of our lives. But, you know, we got the big one, which is the market, which I think is a spectre of red, right, across the board. And let's just quickly rewind the clock and start by telling you the cues. It all started, of course, with the blowout US jobs data, which came through. And this came on Friday, comes around the time the US market opened, and it was a big blowout number. So very strong. It is basically what is done is naturally reduced the need for interest rate cuts. I mean, so the bets were already deepening that Fed will perhaps cut only twice. Now probably it's down to one, according to many. Now the number itself, the December jobs number, 256,000 increase compared to 165, which was the consensus. So, you know, that is a 100,000 beat. You got unemployment rate 4.1 compared to 4.2, so it's dropped. Lesser sort of unemployment out there, and average hourly earnings, another important metric, was absolutely steady. So these are the numbers. What the consequence of all of this? Most large mainstream banks, global banks, have shifted their Fed forecasts to fewer or later starting cuts, right? I mean, some are saying maybe June, some are saying later, some are saying maybe not in 2025 at all. So Bank of America, by the way, is one of those banks, and I wanted to just, there are many, and we'll put out more views. They are no longer expecting any cuts in 2025. And they're saying that the next first move from the Fed from here will probably be a hike, not a cut. Now, that is a dramatic U-turn that we've seen coming through. The markets now, S&P was down 1.5, NASDAQ was down 1.6, and the Russell 2000 was down about 2.3%. These are large, sharp cuts coming through, but I mean, keep in mind when you look at these cuts that the market in India is already about 10-11% off from the all-time highs. In the US, I mean, we've barely scratched the surface in terms of any correction. So that's a big difference here when you try and extrapolate some of this to what's likely to happen here. The wicks went past the 20 briefly, but then kind of settled under it. The 10-year, again, bond yields across the board, you look at the 2, the 10, actually the front end, the 2 and the 5 were the ones which saw, 12, 13 basis point moves, but the more tracked 10-year was up 7. The 30-year yield in the US went up above 5% for the first time in over a year. So just some action in the US rates market across developed markets. And, a case in point, of course, is the UK, which is seeing another big blowout move in yields, largely because of the fiscal problem. Yields across developed markets last week up between 17 and 25 basis point. So this is largely a problem with regards to, two things. One, US is kind of running ahead of everyone else. And of course, the second is that everywhere deficits and debt, etc., are mounting, especially in the face of slower growth. And once again, I go back to making that point with the help of the UK. Dollar index, 109.65. You have and of course, the other one is oil prices, which is also important for India. So we left off just under 80, but this morning, I think oil prices have surged a little bit more. So we're now talking about between Friday and today, this morning, we're talking about almost a 5% move, and we'll talk more about this as we kind of go along. If I can just quickly put out the dollar rupee as well. The dollar rupee has actually gone past 86. So it happened after India equity close on Friday. So we left off at about 85.9650, but it went past 86 onshore, and I think went up as high as about 86.10 or so. So keep an eye on the currency here in India as well as we trade start this morning. Now, just to tie in the levels, Nifty, it's closed below the critical support zone of 23,460 and 23,500. What are we looking at? November lows, which is 23,263. That's the next big number in that sense, which kind of comes into focus. It's some distance away. So, but you start to imagine a market where probably we kind of get to that eventually, unless and until things start to reverse very quickly globally. Resistance comes in at the 40-hourly exponential moving average, which is 23,625, just 200 points away from where we left off on Friday. Bank Nifty support comes in at 48,264. So that is about 0.7% away. And the Nifty Bank resistance, again, is the 40-hourly exponential, 49,768 is where we are looking at. So those are numbers and levels. For the day, just for the day, it is possible that in the first half, there is, of course, going to be that reaction to the Fed, etc. But we've seen this many times play out, especially after the jobs number, specifically after the jobs data, and maybe after other data points as well. When the market here has already, in a way, come in, has been correcting and gone into a data point in a very corrective kind of fashion, the second half turns out to be a little better. So let's see if that indeed is possible. But I think in the first half, because of the way the market has been trading and the sharp gap down, there perhaps will be some margin requirements, margin calls, etc. And maybe the second half may be a little better. But 180 points is going to be a slam dunk open on the way down. Surabhi.
Absolutely. So we've got plenty of headwinds in terms of international markets, and Asia right now is trading down anywhere between 0.5% to almost 2%. The Japanese markets are short. The one that's falling the most right now is the Hong Kong market, which is down nearly 2% as we speak, thanks to the shocker of the non-farm payrolls report. And the expectation was 155,000 jobs will be added. What actually was added was 256,000. So the beat was a substantial one, which is why we had that move across asset classes, with US yields now being at the highest levels that we've seen in the last 14 odd months. By the way, if you're looking at the rate cut probabilities, then the probability of zero rate cut in the January meeting, which is coming in on the 29th, is as high as 97%. The next meeting comes in March, and there also the probability of no rate cut is as high as 78%. So a lot of this pushback in terms of market expectations on lower rates, that's all getting priced in, and it's been painful, in terms of the asset class moves as well. On oil, I just want to talk about this move that we've had. 5%. 3.5% on Friday, another 2% this morning has taken Brent above 81. So what's the issue? US has imposed sanctions on a whole host of Russian entities, Russian oil companies, their executives, and more, oil tankers as well. And this includes entities like Gazprom. Even Gazprom's CEO has been sanctioned. And a lot of the Russian tankers that are ferrying oil, bulk of them have been coming under sanctions. So there's worry about what this means in terms of the immediate reaction in oil supplies in the market, because Russian oil is going to be pushed back, which has caused this move. We'll talk about this with Manisha as well as we go forward. Along with the non-farm payrolls report, there were two other data points that were weak in the US. One is the consumer sentiment index that missed the mark for January. And then the University of Michigan does the inflation expectations survey. And the one-year inflation expectations have surged up to 3.3% in the latest print versus 2.8% in December. And even long-term inflation expectations are the highest they've been since the GFC, the global financial crisis, descended upon the world in 2008. So inflation is a big bothersome point, which is why we're seeing the kind of moves that we are in asset classes. Now the silver lining. Here at home, IIP has actually improved to a multi-month high. We haven't seen these kind of numbers in the last 5 months. 5.2% is the November print coming in, and the improvement is across the board in the electricity output, in mining, in manufacturing. In fact, the capital goods output is at 9% in November versus 3% in the previous month. So this is the good news, but is it going to be enough? Fund flows, it's the same story. We sound like a bit of a broken record, but then that's how it is. Once again, FIIs on the sell side, they sold off equities, cash equities worth about 2,200 crores. Domestic institutions have been buying 3,900, but it's not enough because apart from the FPI selling, there's obviously a lot of selling at the direct retail level, perhaps selling at the at the level of family offices, etc., and the HNI segment, which is responsible for what we've been seeing. Lots of stocks are going to be in focus. Earnings season has started. DMart has reported numbers. The revenues are looking good. For Just Dial, I mean, it's a mixed bag, and we'll talk about it. Oberoi Realty is interesting. They're going to be developing a very large parcel of land in prime, Mumbai suburbs in Bandra. It's a slum rehabilitation project, so watch out for this one. And there's good news for Biocon coming in for their Malaysia facility from the US FDA. Today's result tally includes HCL Tech, Anand Rathi Wealth, Angel One, Delta Corp. So lots of stock-specific action. But Nigel, it's this big slam dunk, the global slam dunk that we have to deal with first.
Well, that's right. I just want to tell viewers out there, investors out there, that sometimes these kind of periods are the best opportunity to build a portfolio for longer term. So don't lose heart on that fact. For the day itself, well, the GIFT Nifty, that's the suggestion that we pull back closer around 180 to 200 points. So clearly, it's going to be a weak start. And the troika is against us. Crude prices are higher, the dollar index is stronger, and yields as well have moved up. So the troika is against us, and that's why we're likely to start off very, very weak. The FI net short positions, well, that's moved to the highest levels we've seen in multiple months. So that from the start of the week at around 2.2 lakh contracts on the short side, that's moved to around 2.8 lakh contracts on the short side. And guess what? The clients, they have in fact adding long positions, and they're adding into this weakness. Because from around 2.5 lakh contracts on the long side, now they're moved to around 3 lakh contracts. And this is the highest that we've seen all the way since the election verdict day. At that point of time, remember, the markets were a little bit jittery, and the long positions at that time were 3.3 lakh contracts. So similar case right now, lot of pessimism, but the clients, they are net long on the index. Let's see whether or not they get it right yet again, because in June, they were bang on and we saw a big recovery from the lows that we saw out there. 2 strikes active, 23,500 called, 23,400 put. Both of them come up for you on the screen with premium at around 130 to around 140 rupees. Now the lows need to be protected. And the recent reference low that we have is roughly around 23,250. Going by the options data, going by the technical levels as well, that 23,250 level needs to get defended on a closing basis. So that's the level we're talking about. The November lows, you don't want this level to break out. And otherwise, the recent reference points that you have for you on the screen, we're likely to break the Friday's low as well. But you don't want to break that 23,250 to give the bulls some kind of a hope to fight back, because the odds are stacked against them. But many a time we see that if some kind of glimmer of good news can lead to a bit of a short covering bounce, and that's the hope. The problem is the Nifty Bank. That's been making lower highs and it's been making lower lows as well. So you'll want this trend to reverse. Those are the highs of the Nifty Bank. You'll get the lows as well. Both of them, lower highs, lower lows, not a great sign technically. And this one needs to get its act together because it's been the big underperformer. Since crude oil prices have spiked up because of potential lower supply coming in from Russia as well as from Iran, well, you have ONGC and Oil India. They could be the stocks to focus on that crude play. So we start off in the red, but don't rule out a fight back at some point of time. The structure is weak, but a short covering bounce is very much new.
Okay, let's see how this plays out. Gearing up for a bit of a rough start. On equities, Chetan Seth of Nomura says the strong non-farm payrolls print on Friday will not come as good news for Asian stocks as it further drives up the dollar and US bond yields. And the market is increasingly pricing in a long pause from the Fed. He thinks investors need not be overly pessimistic, though, as an opportunity to raise risk exposure might emerge sometime during the year when markets reach peak pessimism and the specter of tariffs is behind us.
Okay, this is the economist from Citi who weighs in next, and he sees the next Fed rate cuts as most likely to be delivered at the May FOMC meeting. He says a March cut is possible if labor market data weakens sharply, but Fed officials might wait until June and then cut rates at a slower pace if the unemployment rate remains 4 to 4.2%. He says they are not particularly concerned about scenarios in which the Fed does not cut this year or considers hikes.
Michael Ferroli of JP Morgan says that they now look for the Fed to hold policy steady until June, then cut twice this year, also in September, to bring the target range for the policy rate to 3.75 to 4% by the end of the third quarter of 2025.
All right, so that's the backdrop, right? I mean, it's clearly negative and it's clearly looking all red across. But, markets are markets. They are forward pricing mechanisms. Rahul Chadda is founder and chief investment officer at Shikara Investment. Rahul, great to have you with us here. Good morning. Thank you very much for joining us. Prashant this side. Now, the Nifty is already down about 10-11% from its all-time highs. Where does it leave us in this sort of very tough kind of macro backdrop at this point in time? How much more downside, if you can kind of start there, and then we can get into it?
Yeah. So Prashant, if you look at markets have a habit of overshooting, which was happening in September, and almost everybody gave up on correction. We heard the statements like it's a melt up, valuations don't matter. And now we see things happening on the other side, which is kind of they're undershooting in terms of a valuation perspective. If you talk about Nifty correction from the highs, but if you look in dollar terms, we've had another 5 to 7% rupee depreciation. So the markets for the strong structural story India is in dollar terms effectively 17-18% cheaper. I think first quarter is going to be choppy. First is what we're talking about, the rate cuts getting pushed out, and they got pushed out because of the non-farm payrolls, which were a high number. We would take these payrolls with a pinch of salt. We've seen huge amount of revisions which come with a 2-3 month lag to the payrolls. Bulk of the hiring over last 15 to 18 months has been government and healthcare and hospitality sector. So I'm not sure how much would that continue. And somewhere dollar strength is a form of tightening. Somewhere these high rates are going to work into the economy in form of a tightening. So our sense is US economic data slows down in the second half of this year. What is spooking the markets at this point of time is the uncertainty from the new administration. What does the new administration have on tariffs? Are they going to kind of renew those tax cuts, which means pressure on FIS? And that's why the bond yields are spiking. But in a way, the spike in bond yields is good because somewhere this provides the guardrails for the new administration not to do anything radical and to be fiscally prudent. So I think I would be slowly buying into the dips. This is what we are going out and telling our investors that, look, next 3 to 6 months give you an opportunity. For India specifically, I think large caps become attractive. And then in due course, after seeing these mid-small caps correct another 15-20%, they come again in the buy zone.
Rahul, on those tariffs which you said are the uncertainty, it's a team made up of largely businessmen, right? Not largely, but it's got Mr. Besant, who's as savvy a market person as any. Donald Trump himself. So while we are hearing a lot of tariffs and fire and fury, at the end of the day, what they do you think it'll be calibrated and it'll be done in a way where, it doesn't really send everything in a spiral? Shouldn't one expect that? What's your sense?
Absolutely. See, you're absolutely right over this. You look at Scott Bessent as a Treasury Secretary, and you look at Lighthizer is out the administration. He's not got any big serious rules, etc. And at the end of the day, our view is Donald Trump wants to leave a legacy as the second president, and that is strong US growth, inflation, and deficits under check. So which is where markets are going to be positively surprised by what they see from a tariffs perspective. And look, investors are over-allocated, overexposed to US. EMs are the cheapest they've been to US in the last 30 years. And as some of these things kind of recede, I think incrementally you're going to see flows. And we've seen emerging markets do not require much flows to change things. Basically, these are not very liquid. And in today's world, everybody's on the same side of the trade, which is why your up moves get exacerbated. And same thing happens on down ticks like the way it's happening now.
Fair point, Rahul. But the thing is, when those down moves are happening, it becomes tough just sentimentally, right? It's human psyche. It becomes tough to go in and buy against the tide, which brings me to the larger point of the India market construct that you have at this juncture, because banks or large caps are being slammed with all this FPI selling, so you have to work against that. Locally, there's a narrative of maybe a slowdown. Consumer companies have been talking about it. Earnings have been slow. So here, what is it that you are asking clients to buy?
Yeah. So from our perspective, look, last couple of months, we've kind of tilted the portfolio towards IT and pharma, healthcare. In fact, the tilt started from June of this year, where we realized, look, the domestic economic sectors domestic cyclicals were a bit expensive. You could see RBI tightening, and that had to have some impact on the growth. A lot of these projects which were completed ahead of the elections will take a while to come back. So you knew, and there was a fair bit of an exuberance. So which is why we were conservatively positioned. That's worked well. You look at these AI spends, they're going mainstreams. Look at the order booking which TCS gave. That gives comfort on that. And IT and pharma benefit from the rupee depreciation. So clearly, those are the overweight sectors. At the same time, you believe in the India story. So clearly, what one wanted was slightly better entry points, better valuations. We've seen a bit of a growth slowdown come because government's been more fiscally prudent in India, but it's a small cyclical correction, and I think things get better in terms of a growth improving in the coming quarters. So on dips, one would be looking to add consumption space, one would be looking to add domestic cyclicals, etc. And then there are a lot of quality small mid caps. So I think they become attractive. Look, a lot of these stocks went up 3 to 5 times, and it's not fair, much as what we all fund managers talk about. And stocks never really move in a linear way. It's not that every year they'll come and give you 12-13% returns. They move in spurts. And after a strong spurt, which we saw post-COVID, it is but natural for some of these names to correct, particularly small mid-caps, to correct 30-40%.
All right. Hi, Rahul. Good morning. Good to see you in. This is Nigel on this side. Rahul, what about this FI selling? You were talking about believing in the domestic story. Well, the domestic flows are believing in the domestic story. The problem is the FIs. They have been selling, non-stop. December, start of January as well. Do you think at some point of time now, given the entire backdrop for India as a structural story, do you think that should cool off? Point number one. And as you said, the Nifty has corrected around 16% in dollar terms. How much more downside do you think? Another 4-5%, and then it comes to that level where people would like to jump in?
Yeah. So I think our view is somewhere around mid of this year, you would see our end allocators warming up to increasing EMs and India exposure. So that is bound to come. These guys were happily kind of exposed to or versed in the global equities, largely the US equities. But deep inside, everybody realizes that valuations are not cheap. If you look at the large cap names in US, nearly $3 trillion market cap, trading at 25-30 times, it's hard for names to compound at those levels of market caps at that high rates, basically. So which is where EMs become attractive. The reason why we've not seen allocations in last 6 months is from September onwards, there was the sense that Trump administration is going to get voted back to power. You look at the election rhetoric, that was fairly severe. Since the administration's won, which was the results were out in November, things been positive. And you look at the various team members, the various positions which have been given, those are given, as we discussed in this interview, to businessmen, not to ideologists. So I think as the worst case fears don't play out and people realize that there is reasonable growth in emerging markets, particularly markets like India, the fiscal situation is much better. The debt to GDP is much better. I think that's where you should see the outflows turn to inflows.
Rahul, the budget is 3 weeks away. Let me say at the outset, you can't say it doesn't matter. So 30 seconds. Should we expect anything?
I think what happens is with this pressure which is on markets, the worst of the fears don't play out in the budget. The budget may be a market-friendly kind of a budget. We see governments world over, they take a cue from markets in terms of how well the economy is doing. So some correction ahead of the budget is good in terms of market-friendly measures in the budget.
The market always has a mind of its own. Rahul, thanks very much for that. But I was just remembering, it was the July budget, right, when they raised the capital gains tax. The market had its different mood, different mind. Market went up that day, I remember. Despite the rise in taxation and all the tax changes that happened, this time, market has its own mood. We don't know.
Absolutely. And, the only thing is, will they wait to roll out some sort of help for the market? Market friendly is what Rahul said, right? But the global scene is kind of adversarial. So will they kind of wait to, essentially let monetary side pick up the slack first and then do fiscal? It's a sequencing thing, but there are expectations growing from at least equity investors that maybe something will come, maybe some help for the lower end of the segment, because consumption here has been weak. The global stuff is new. Consumption has been weak for the last many quarters now. Let's quickly run you through the corporate interactions which are lined up here on the program. 8:35, you'll hear from Manish Gangwal of Gulf Oil Lubricants. They discuss their 2025 outlook. 9 o'clock, we have Goldman Sachs' Arnab Mitra talking about consumption. Sanjay Mukim of JP Morgan, market master of the day at 9:15. Pradeep Kumar Das of IREDA. Earnings came last week. We have an interesting discussion. The future of real diamonds and the future for lab-grown diamonds. That's a discussion coming up at a little later at 9:40. 9:50, you'll hear from JM Financial Securities' analyst on expectations in the third quarter for oil and gas. It's the economy at 10:15. Lata will be speaking with Anubhuti Sahai and Arup Rakshid. And she'll discuss exactly that. What can monetary policy do in the face of rising dollar and rising developed market yields?
Time to slip into a short break. We got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment. But we'll run into the list for now. We look at Biocon, Just Dial, Suntech, Equinox India, Oberoi Realty, Vauri Energies, NLC India, PCBL and ONGC. So 9 stocks out of 10 could be reacting to positive news flow, but let's see whether they open up in the green. But we'll have Avenue Supermarts. That'll be the Lone Ranger that could be opening up in the red. Slip into that break, come back. We'll get into detail on all these stocks.
Welcome back. So strap up because it promises to be a roller coaster, at least at the start. Asian markets have been reeling under pressure thanks to the losses we've seen on Wall Street. It's all about the jobs report. The implied open is suggesting a 200-point gap down. Okay, but there are lots of earnings, lots of individual stock-specific action that we need to go over as well. So let's get down to the micros now. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning and happy Monday to all of you. Let's start with some of the major earnings that we got over the weekend. Manglam, how does DMart look?
The most important things in DMart's numbers: one, there has been a pickup in revenue growth, but margins have compressed, and there has been a surprising announcement in the leadership change as well. Now, here's the catch. The revenue growth of almost 18%, the street had factored that in. The stock was up 10% post the third quarter update that came by last week as well. So now that leaves us with 2 disappointing facts. One, that the margins have compressed by almost 60 basis points, led lower by increased intensity in discounting in the FMCG category, increased operating expenses on account of store expansion, and general merchandise and apparel, which is close to around 23% of sales, hasn't seen any meaningful recovery or improvement out there. And the second negative, which was a surprise, is that the leader, Neville Naruna, will step down as MD and CEO from February 1, 2026. His current term ends on January 31st, 2026, and he has chosen not to, renew that. And the company has announced Anshul Ashawa as the CEO designate. Anshul, who's currently, the country head of Unilever Thailand, has been with Unilever for the last 30 years. But this transition of management change from what earlier was, known as a rockstar CEO in the retail chain may come across as a negative surprise. This uncertainty would lead the stock lower today in today's trading session, largely on account of margin compression and the management change that has come by.
All right, Manglam, thanks a lot for that. So Avenue Supermarts, pulls back and gives up all that it put on post the Q3 operational update that we saw. Well, let's hop across to Vinny. She's bringing some good news on Biocon. Vinny, take it away.
Absolutely. A strong positive news that's come in for Biocon. Now, Biocon's Malaysia insulin facility, which everyone was waiting out for, they finally received the US FDA's voluntary action indicated. So positive news there. And this is the Johor, Malaysia facility. This was inspected somewhere in September 2024. That time they'd received an OAI that came in for the facility previously. So that was a concern that was there. Now, this clearance paves a lot of positive paths for the Biocon's facility and Biocon Biologics business specifically. Now, Biocon's regulatory hurdles specifically are behind them, whether you look at the Bangalore facility or the Malaysia facility. We'll see a potential launch coming in for the generic Aspart, which is an important biosimilar for the company. Launch will be in the near term anytime soon. And there are 2 launches that are already planned during this year, which are the important ones that they're keeping an eye out on. Now, what analysts are saying that obviously with this launch, the US Aspart sales are expected somewhere between $25 million to $50 million in FY26 and FY27, and it's a $700 million market. So surely keeping an eye out on this one. Green expected for Biocon.
All right, Vinny, thank you very much for that. So it's Biocon in focus. Just Dial is the next one we're going to focus on. Rima is here with details. Rima, morning.
Hi, good morning. So revenue growth for Just Dial has slowed a bit. So revenue growth stands at 0.8% on a quarter-on-quarter basis. On a year-on-year basis, revenue growth is at 8.4%. And this is the second consecutive quarter of a high single-digit kind of revenue growth. Prior to that, it was a lot higher. That said, margins have expanded pretty well for the company at 30.1%. This is the highest that we've seen in the last couple of quarters. It compares with 28.8% in the prior quarter. And if I compare it to a year ago, it was 22.8%. So the margin expansion has been very solid. So profits on a year-on-year basis are higher, but on a quarter-on-quarter basis, they're still lower on account of a lower other income. And this is a company which is generating a lot of cash. So cash in the books is close to about 5,000 crore rupees. So slower revenue growth compared to the prior quarters, but a very strong inch up in margins.
Okay, all right, Rima, got it. Thank you. By the way, our ticker was flashing some very interesting news for IndusInd Bank just a while back. It seems that the latest shareholding shows that the foreign ownership headroom has increased, which is why MSCI could be almost doubling its weight on the stocks. That means good news in terms of the existing flows. Passive flows will come in. Larger question is, of course, whether the funds, emerging market funds, are getting more money or not. But that's everybody's problem, not just IndusInd Bank's. For the time being, because of the existing changes, there would be inflows coming through. I think 225 million is the estimate on the street. So watch out for this one. But anyway, some more names. Let's go to Hormaz now, who's watching out for Wari Energies and NLC. Morning, Hormaz.
Morning, Surabhi. And one of the outperformers, the recent listings is Wari Energies. They have made a big announcement over the weekend where they are going to signed up a share purchase agreement with NL Green Power Development, and they'll be acquiring a 100% stake in the India business of NL Renewables for 792 crore rupees. Now, NL is one of Europe's largest renewable energy companies, and they own both solar and wind projects in India, which has existing capacity and capacity that is under development. So positive developments coming in for Wari Energies. And NLC India as well, they have also signed a 51-49 joint venture with the Assam Power Distribution Company, where they'll be developing solar power projects in the state of Assam, and 51% will be owned by NLC India, while the rest will be owned by the Assam State Discom. So positive developments for NLC India as well. Expect both the stocks to open in the green today.
All right, thanks a lot for that, Hormaz. Well, let's wind this down with Vinny, who's here to tell us about some more stocks that are on the news. Vinny?
Good morning. So I'm going to talk about some of the real estate names. Now, Suntech Realty has come out with its Q3 business update. Pre-sales, strong pre-sales, right? 40% growth that we're seeing there, 635 crores. But there's a bit of a decline that's come in on the collection front, down 23% on a year-on-year basis. So maybe the stock could open up in the green and then move towards the muted side. We have Inox, that's also going to be in Equinox, I beg your pardon. Equinox is going to be in focus. They've come out with their Q3 FY25 numbers. Now, strong set of numbers coming in. Profits coming in at around 22 crores versus the loss last year of 38 crores. Revenue seeing a very strong growth, almost more than doubling, tripling in terms of the revenue move that we're seeing. EBITDA also, it's a EBITDA profit this time versus a loss last year. So good set of numbers. Do not forget in terms of recent announcements where the NCLAT had approved the scheme of amalgamation for Equinox India Developments as well as Embassy Group. So keeping a close eye on Equinox, expecting green today as well. Oberoi Realty is the last one. The company has been approved and appointed as the developer for a 10,300 square meter of land that's in Bandra, and the company is expected to be entitled for the free sales of the component of around 3.2 lakh square feet. So positive for that one as well.
All right. Very thank you again for that. Well, PCBL third quarter review. Upasana is standing by with that. Upasana, morning.
Good morning. Well, overall, it's been a decent quarter for the company when we look at the numbers on a Y-on-Y basis. Revenue stood at 2,010 crore with an uptick of 21% on a Y-on-Y basis. Now, this revenue growth was mainly led by company's key segment, that is carbon black, which forms nearly about 80% of the company's overall sales mix. Now, other segments like power and chemicals also showed growth potential, and chemicals being a new revenue stream this year, mind you. Now, on EBITDA margin front, it stood at 15.9% with a downtick of 90 basis points on a Y-on-Y basis. And company's PAT stood at 93 crore with a downtick of 37%. Now, this downtick was mainly led by 5x surge in company's finance cost, and company's depreciation also doubled this quarter, leading to such a impacting PAT growth. Now, company says that company is expecting a significant growth in the international sales volume to European markets, and it has also highlighted that the demand for specialty products continues to remain resilient. So overall, it's been a decent quarter for PCBL.
All right, got it. So we're going to keep this one on the radar as well. Upasana, thank you very much for that. Let's quickly recap the stocks to watch today. In fact, actually, before we we do that, let's head across to Manisha. Oil is the major headline. Apart from the US non-farm payrolls report, the market's now dealing with almost a 5% increase in oil prices since we shut trade here in India at 3:30 on Friday. Manisha, waking up to news of Russia sanctions. What's going on?
Oh, well, absolutely. So we've seen 3 weeks of constant gains for the crude oil prices. This is the 4th one, and 2025 has started on a very, very positive note. As you said, we've seen strong gains. Last week was 6% of gain for the crude oil prices, and Asia is up almost 2% right now. So very, very strong going here. Yes, you spoke about U.S. sanctions on Russia, and that really is a major reason. So while Russia has seen sanctions on various other sectors, this is the first time that we are seeing such stringent and strong ones come in on its oil and gas sector. So the U.S. Department of Treasury has imposed sanctions on Russian oil producers, on more than 200 entities and individuals, on 183 vessels that are shipping Russian oil. There are sanctions also now on Russian insurance companies, and this could have a wider U.S. sanctions impact on China and India, because much of the Russian exports were happening within Asia. The other point is that UK has joined US in targeting Russian energy sector. So this is still a developing thing. You could see more countries joining in. And how stringent is this? At this point in time, there's a statement from Gazprom saying that this is unjustified, illegitimate, and they will continue to operate. So clearly not taking sanctions as they come. So this is still high, and the premium in the crude oil prices perhaps could even gain further going forward.
Oof, the Biden administration is definitely going out with a bang, no, Manisha? Because we thought it would be quiet and things will start only after the 20th of January. No, never a dull moment. Headlines are still coming in. Thank you so much. We'll get more perspective on this with you through the course of the day. Okay, so oil also is the big headline. Let's quickly now recap our list of total top stocks to watch. The ones that have positive news flow are Biocon, Just Dial, Sunteck Realty, Equinox India, Oberoi Realty, Wari Energies, which has acquired a company, NLC India, PCBL, and ONGC, thanks to the spot in oil prices. Avenue Supermarts, because of the numbers being a mixed bag, could be the one in the red. Okay, quick break right now. We'll come back on the other side and connect with Prakash Diwan, discuss fundamentals around some of these stocks.
Okay, welcome back. There's 20 minutes to go for the pre-open session, and it's busy. It's going to be a busy top-down kind of a day, right? Because it's all global in that sense. GIFT Nifty indicating about nearly 200 point lower start straight up this morning. Prakash Diwan is with us with his thoughts. Prakash, good to have you with us here. I was just wondering aloud whether we talk about H1, H2, but let's reduce it in terms of daily time frames. First half, perhaps, of course, you got to deal with all of that. And maybe second half, the market here is already down 10-11% from the highs. So when you do this on a day-to-day basis, all of this comes into a little bit of focus. What's your sense? Maybe second half a little better? And how will it play through?
Good morning, Bish. And so I do understand the restlessness of the market to see some sort of a stop to this capitulation that seems to be underway. But when you look at how the numbers stack up, I'm not surprised. You look at the Friday DII buying number, wasn't very small either. FIs have been selling since the last month and a half, 2 months maybe. So what's happening is it's the absence of any kind of a buying interest from HNIs or retail or whatever you call it. There is this gap, and that's putting a lot of pressure on the way down. Valuations have, of course, not been very comforting. So they will take time to kind of come to a level where they become attractive. And my sense is still the 20th of Jan, and I've been repeatedly saying this since almost a month, that there's not much of direction that you would have in terms of the market. It could only be uncertainty, which is tending to be negative. So, and growth, of course, needs to still come back, Prashant. We've not seen a Q2, which was very encouraging. Q3 hasn't started off except for the TCS spark. So we'll have to wait for these things to kind of pan out, and which is great news for long-term investors. I don't see the India story fizzling out in that sense, but it's a global setup that's impacting us. Second half of this kind of a market could probably be more result-driven, earnings-driven, rather than just the news flow around certain stocks. But I wouldn't really hazard a guess whether the market is yet in a position to bounce back very soon. In fact, the only glimmer of hope seems to be the budget, because that could get things moving from a slightly longer-term perspective.
Sure. Prakash, stay on and, just request you to prep up for some of these crude oil sensitives, because we want to talk about this 5% surge in oil prices. So what that might mean in the near term in terms of a trade or a hit on tire companies, paint companies, and of course, oil marketing companies. We'll get to Prakash on that in just a bit, but let's also chat with Gulf Oil Lubricants, the first corporate management that we have on our show today. The company recently entered into a strategic partnership with Nayara Energy to expand its automotive product offerings. So, they're launching a range of lubricants across India. We'll talk about that with Manish Gangwal, Chief Financial Officer at Gulf Oil Lubricants. Mr. Gangwal, thanks for joining in and thanks for taking the call. We'll get to the tie-up and your new offering in just a bit, but the bigger sort of market concern this morning is this big surge in oil prices. Now, when we spoke with you in December, at that point, obviously, this was not a concern, and you told us that, things are pretty steady on the margin front. What is the sensitivity for you, say, for every dollar increase in Brent? Can you give us some sense of what that impact is on margins and how you're looking at the current surge with now Brent above $81?
Yeah, good morning. Thanks for having me. Yeah, I think you're right. The crude has really surged in the last 1 week or so in a way which was not anticipated. Everybody was talking about, and the global scenario was like China demand is low and the crude is going to remain subdued in a way. We are seeing suddenly a jump from nearly $70, $72 to now $80 plus. Obviously, for us, our key raw material is base oil, which is a derivative of crude, of course, but the effect comes with a lag. So usually there is 1 to 2 months of lag before the impact is seen on the derivative base oil. And we get enough time in between to, take our pricing calls and, manage our margins. We do carry some inventory also, base oil, obviously, because it's an largely imported commodity. So obviously, we will watch for this crude movement. Obviously, if the crude remains at these elevated levels or touches around $85, and the pricing decisions may need to be taken in terms of margin management. But as of now, we have to wait and watch. Another obviously thing is the rupee depreciation, which has happened in the last 1.5 months, which also impacts our landed cost in terms of, because mostly the base oil is imported, as I mentioned. So both of these have to be combinedly seen, and then we have to really take our decisions. But obviously, we have to watch this space very closely for margin management.
No, absolutely. And I'm glad you brought up the other important point as well. The rupee depreciation is not helping for importers. So again, some sense, Mr. Gangwal, in terms of your margins have been around 12.5%, right? Now that you're dealing with not one but two headwinds, what is the price elasticity that you have in the market? How much, if we look at numbers, immediate numbers available with the rupee depreciating and oil prices escalating, If you want to entirely mitigate the margin impact, then how much of a price increase will you need to take? You may or may not take that kind of price increase, depending on competitive intensity in the market. But what is the quantum that could be needed, seeing these two factors play out?
So in the past, we have always seen that when these kind of movements have happened, we have been in a position to pass on the increases to the end consumer customers, and especially in our OEM businesses, we have a price variation clauses which are triggered quarterly in most cases. So obviously, with that, we'll be in a position to mitigate the margins. To give you a ballpark figure, it's very difficult because there are various grades of base oil which has demand-supply situation also. Sometimes the Group 1 base oil becomes less available as compared to Group 2. So there are various permutation combinations. But in a sense, we do not take price increases or price schemes. We usually adjust in short term with the scheme management. And if there is a sustainable increase over a period, then we may have to change the prices at the MRP level. So that is a wait and watch situation as of now. And I can only say that we will be definitely watching for the next 15-20 days in terms of how the movement is happening. And then post budget, maybe we will be taking some calls on the pricing, which can be either by way of adjustment of schemes or by way of MRP level increases. But to really give a figure at this moment depends on how the crude and rupee behaves between now and next 15-20 days.
But Mr. Gangwal, can you assure investors that there will be no margin hit? What is, let's talk about exit margins, FY25 exit margins. Where would you want to be?
So typically we are in a band of 12 to 14% EBITDA, and we definitely, as you rightly mentioned, we were at 12.5, 13% band. We would be maintaining that margin band of 12 to 14% EBITDA for sure. That has been our trend, and usually these are the opportunities also when you sometimes take up the price increase, and when the crude cools off in a way, you end up retaining some margins as well. So these are sometimes can turn out into an opportunity as well on a longer period basis.
All right. Thank you very much for joining us. It's a pleasure, and good luck. We'll speak again post the third quarter earnings, which should be soon as well. So that's Gulf for Lubricants. Prakash is with us. Prakash, I just wanted your thoughts on IndusInd Bank. I mean, I don't know if you saw that news item which came through. This is, of course, this is technical. I mean, the MSCI flows and passive flows, the readjustment, which means that some $225 million worth of IndusInd stock needs to be bought. It's corrected sharply, closer to 900 than to 1,000 now. What's your sense? The indication is Q3 will once again be bad, but valuations have also corrected. Your thoughts?
No, absolutely. Another data point is one of the brokerages, MK or somebody's also put it on the buy list for 2025, which is probably the only bank in its list for the time being. And interestingly, the BFSI space, especially these largish banks, are not. If you take the top four out, these banks are actually not valued in sync with some of the larger ones. So what's going to happen is when things start looking up, and that could either be in terms of their interest costs finally coming down, and that could happen post Q4 or during Q4, and of course credit growth also making a sort of a comeback. IndusInd has already got into that repair mode, Prashant. So if Q3 is going to be the last quarter where you'll see all the issues related to unsecured loans, personal loans coming into play, that's probably the time to kind of buy into it. I mean, you could buy it earlier as well. The risk reward is favorable, but it just gets better if Q3 gives you a little bit of a whopper of a number, and then things could look up. So I do agree at some 1,000 levels. It definitely gives you a very decent risk reward where you could have a 30-40% upside in the year as well. So that's the kind of risk reward it's sitting.
Okay, all right. Prakash, one quick question on crude oil prices spiking up. You have ONGC that could be in focus, Oil India as well.
Yeah.
Any view on both those two names?
Very positive on ONGC. Not so much on Oil India because it also has certain other legs of the business which could not be as fast moving, but ONGC certainly, my sense is it's made a recent bottom, and the kind of buying interest that could come from here on could take it at least $40-50 higher, which is in percentage terms almost like 20%. So this could be a very quick move because it's a catch-up. The fall was precipitous, and 330, 335 seems like a very doable thing for the time.
All right, shorter conversation, Prakash, but lots to pack in. But we'll speak again. Thank you very much for joining us with all that perspective. Thank you. We take a break. Mitesh and Sudarshan will with us on the other side. Technically, what should you do? What are the trades to take? So that's an important conversation which comes up.
Welcome back. Well, GIFT Nifty suggesting we're going to pull back around 220 points. That would mean that we're going to breach the lows that we saw in November to start off with. The 23,250 mark, that's the crucial mark the bulls will want to defend on a closing basis. Mitesh Thakkar as well as Sudarshan Sukhani join us on the show. Good morning, gentlemen. Thanks a lot for joining in. Well, Mitesh, you go first. Stay away from the dip or buy the dip. How much lower can we go?
Good morning, Nigel. Take profits. Idea. See, I think, we've been having bear spreads on the index, and that's worked out really well. Around 23,350, which was the closing low last time the markets bottomed out, sometime in November, and 23,260, which was the intraday low. I think you might see some kind of a support, pullback, short covering come in, a bounce from oversold levels. I think all these factors can combine together. So I think today's gap down would be a good idea to first book some profits on your short positions if you've been carrying, and then wait it out to see if there is any kind of bounce back happening. Otherwise, we will believe that the markets are poised to go lower. I was working on slightly longer term charts. Good chance that in case we fail to capture 23,350 again in the next few days properly, then I think we might head towards 25,600, 550 zone. So there could be another 700-800 points dip left on the Nifty on the slightly medium term perspective. But in the short term, as I said today, if the gap down doesn't provide you follow through, then I think we will want to take some profits and explore some kind of stocks which can reverse from oversold levels. So the start of the day is with a negative tone.
Okay, all right, got that. Mitesh, Sudarshan, morning to you as well. So it's turning out to be difficult. I mean, the cues are so negative for the index. Would you look at a downtrade at all?
Yeah, good morning. See, once the Nifty broke 23,800, the trend changed down, not just sideways, not a dip, but a downtrend. Now, in a downtrend, there are only two trades. One is that we do nothing because we have a larger uptrend in the, Nifty usually has a significant long-term bull market. And the second trade is, the first do nothing. The second is to sell on rallies. I think the sell on rallies trade is probably worth examining for savvy traders. Most traders would do well to do nothing in this trade, but this is not a dip. So at least buying is not recommended. There's also a larger picture building up, which is not very cheerful. And that is that the Nifty may be, the key word here is may. It may be heading towards a test of the election result lows of 21,500. So all in all, this is not a buy on dips environment. Best is to stay away. Savvy traders can look to go short.
Okay, all right. So this is not a buy on dip sort of an environment. That's the word of caution from our technical experts. We need to take a break. We'll come back with more stock-specific ideas on the other side. We'll also have the pre-opening trades.
Okay, I think we've got the pre-open rate starting to come up on your screens. Nifty is down 130, Sensex is down 160, but the dollar rupee will also be starting to trade. And I think we'll have the first sort of rates coming up on our screens in just a bit from now. So just waiting for that. So 86.20 is the dollar rupee on the currency cross. So I think we did get to about 86.20 or so. On the dollar rupee on Friday, I think onshore. Here in India, of course, we broke 86 after the equity market closed. I think we went up all the way to about 86.10 or so on Friday. Remember, equity markets close at 3:30 and currency markets close at 5. So after 3:30, after the equity market closed, we did see a sharp fall. This was before pre-NFP, remember. And of course, there was a bit of a pullback then because markets closed. But this morning, of course, there is the full weight of that rise in the dollar, rise in yields, and generally, I mean, you know, the macro turmoil which is showing up. So it's a full 0.25% fall in the dollar rupee coming through. So at about 86.20 or so. We'll get you some more opinion as we kind of go along in a bit from now.
You know, Prashant, while we're talking about the Indian rupee, because the context is it's all benchmarked against the dollar, it's not an India-specific issue. Look at the dollar index's rally. It's zoomed like a rocket in the last, I think, 1 or 2 hours. 109.79. So suddenly we're tracking closer to 110 on the DXY itself. So big moves in the international markets.
And, you know, the thing is, you look at what, and this is the point, right? This is the conundrum for policymakers, etc. as well. I mean, when you talk about the budget and you talk to equity investors, what should they do? The point is it's a broad sort of dollar rise. It's not individual sort of markets or individual currencies here and there which are under pressure because of country-specific reasons. This is largely a dollar move. So, I mean, look at what the Chinese are doing. They're kind of giving up on bond buying, at least for now, because there's no point. Why? Why continue the effort? Because it's a large dollar move which is underway. Look at what's happening in the UK, for example. So, I think it's an interesting time from both monetary and fiscal point of view. But I think it's also a challenging sort of time period in that sense. 200 points lower on the Nifty. The Nifty Bank, of course, also sharply down at this stage. Mitesh and Sudarshan are with us, and you know, we'll talk about individual trades, right? We talked about the broader view. Mitesh, what would you do?
Good morning, Prashant. I begin the day with all sell calls because that's the way market will be, and there are no buying ideas for the time being. A couple of pharma names which have seen a breakdown is one of them is Torrent Pharma, which I would recommend selling with a stop at 3,300 for targets of 3,200. Now, if the stock opens with a big gap down, then we'll have to avoid the trade. Same view on Aurobindo Pharma, sell here with a stop at 1,215 for targets of 1160. After a long time, BSC is showing signs of correction, so that's a sell with a stop at 5210 for targets of 4950, and CG Power is sell with a stop at 663 for targets of 620.
Okay, so plenty of sell ideas there on Mitesh's list. Got that. So Darshan, what about you? Individual stocks?
Well, I have two positional trading ideas. The fact that we are looking at a dip or a decline makes them attractive. They are not day trades. You have to hold them. TCS is a buy with a stop under 41.80, and JSW Steel is another buying idea with a stop under 8.80. The stops can be adjusted a little. Sun Pharma is an intraday short with a stop above 18.20, and Adani Enterprises is another intraday short with a stop above 24.20. My suggestion would be to wait patiently for markets to stabilize before taking any trades.
Okay, I just want to quickly point out the rate on Avenue Supermarts in pre-open. This may not, be the actual, but for what it's worth, I mean, the pre-open rate suddenly suggesting a 10% dip. We know that, it's a mixed bag in terms of the numbers, the performance, with the pressure on margins. But I'm not sure if this is how severe it might play out, but just keep that on the radar. And otherwise, as the oil trade is the big trade in the market, everything that's oil sensitive is down, whether it's OMC stocks, tire stocks, etc. So keep an eye out on that as well. But FNO now?
Well, that's right. And, talking about oil sensitives, you have ONGC is a little higher and Oil India is a little bit higher, because they are potential beneficiaries of that. But Chandan Taparia joins us to help us out with some derivative strategy as well. Chandan, it's not looking too good from a bullish perspective, but do you expect some kind of support as per the derivative strategy at lower levels? And fill us in with the strategy as well as stock-specific action.
Good morning, Nigel. Thanks for having me. So Dow has seen a corrective move below 42,000 and making lower top, lower bottom. Dollar index is now hitting to 109, 110. CBOE VIX is 20. India VIX is quoting at 15 marks. So multiple indicators are indicating about the weakness in the broader sentiment. As per the seasonality in the month of Jan, India VIX witnesses surge, and that is the track record of last 10 January out of 10 years. So that clearly indicates that fasten your seatbelt and roller coaster ride with some weakness could continue in Indian market for next couple of more weeks. Bank Nifty has given a breakdown, trading at 6 months low levels, holding well below 50,000 can take it towards 47,000 to 47,500. Bank Nifty, till it holds below 23,650, it can retest to a major support of 22,800 zone. Looking at the stock first, that is buy on HCL Tech. Selective IT stocks are likely to do well, and this is the only sector which is finding some bullish resistance in this current market scenario. Has been moving in a rising channel, taken support at key moving averages, so one can buy with support of 1940 for an upside target towards 2060. Second trading idea, there is buy on Bharti. Low beta name has been consolidating with sustained buying interest. We have seen some put writing activity. So with support of 1585, we can see a surge in price towards 1680 level. Last trading idea, there is sell on AB Capital. We are expecting weakness to continue. It has been making lower top, lower bottom. Shorts with sustained call writing are hinting on the downside move. So one can sell with a stop loss of 173, and AB Capital can go till 158 and even lower levels.
This morning, I think there is a that's the beauty, right? Technicals and fundamentals. Chandan, thank you very much for that. Morgan this morning, I think, has got a buy call on AB. I think AB Capital. They're saying, well, they see deep value, etc. So, technicals. You look at the price action, and that's looking weak. And precisely because it is looking weak, I mean, on the funda side, you got Morgan, which has actually come out with a buy and a sort of value proposition there. Stocks actually starting to higher. Let's see where it goes. Let's focus on the FMCG space. Goldman Sachs is bullish on some of these names. We have the analyst with us joining us, Arnab Mitra, India Consumer Analyst at Goldman Sachs. Arnab, good morning. Good to have you with us here. Thank you for your time. Before we get into individual sort of factors at play here, we got the big macro event, which is the budget around the corner. Do you think it'll provide any help? I think Goldman has put out their budget preview note this morning. Do you think we should keep any hopes from that from the budget on the 1st of February?
Yeah, good morning. Thanks for having me on. So I think on the budget, we do expect a gradual tilt towards welfare spending, which is what our economists have put out. However, what I've seen in my experience of covering the sector for a long time is that these changes at the margin do not significantly affect consumption at a macro level. The larger factors at play, let's say last year, we had a lot of headwinds in the sector, like urban consumption slowdown. We had very sharp commodity inflation in palm oil and tea kind of commodities, and very intense competitive intensity. I think our view will be to watch out for those three factors, how they change over the next 12 months. They will determine the fate of the sector in terms of how these stocks do. Government, I would say, should be slightly supportive, the government action, but I would not say that's the major, thing that we are looking at for 2025.
All right. Hi, Arnab. Good morning and good to see you. When consumer sentiment seems to be a little bit weakish, which is a bit of a worry. What are you factoring in terms of demand recovery as well as the turn of sentiment?
Yeah. So if you really look at why 2024 was a weak year for the sector, we identified three main headwinds, which we spoke about in our outlook report. The first was this urban consumption slowdown, which happened due to the combination of the very high food inflation, persistently high food inflation, and the slowdown in unsecured lending. And also remember, we had this, two Ws playing out, which is weddings plus weather. We had very, very low wedding dates for almost 8-9 months in the year, starting from the 1Q to the end of the 2Q. And we had extremely odd weather conditions, where the June quarter was too hot, there was too much rain in the September quarter. So all of this came together to cause the urban consumption slowdown. So what we are seeing really is that this weddings plus weather headwind is probably behind. So we are seeing some signs of recovery in terms of retail footfalls in the retail space. Food inflation, we do expect it to now start moderating. It was mainly driven by vegetables inflation. Our economists do believe starting from the March quarter, we will see a moderation in food inflation, and these two would be a catalyst for slight recovery. Unsecured lending slowdown probably still continues for some time, so that will continue to be a headwind, but we should be in a better place in 2025 than 24. So that's the first thing, I think, which is driving our somewhat positive stance on certain stocks. Second is, we had this extremely sharp commodity inflation, especially in palm oil and tea, and also in other commodities like coffee and cocoa. It affected specific categories like soaps, biscuits, some other foods categories, and that actually also constrains demand because you had to take very high price increases. Many of these companies had to also take margin hit in the initial period, and we are clearly seeing signs of that starting to reverse. In fact, palm oil prices have corrected nearly 15-20% from the peak in the last 1 month. So that's also driving us slightly positive in certain stocks. However, where we are still cautious is segments where there was intense competitive intensity. So paints and grocery retailing are two areas where competitive intensity has gone up dramatically because of new entrants as well as new business models like quick commerce and grocery retailing. And there we think the headwinds in 2025 will be actually more than 2024 as these disruptions increase. So we are slightly cautious on those spaces, but positive on things like QSR, where urban recovery is a big factor, and select FMCG names where the commodity moderation coupled with a slight urban pickup would be a positive factor.
Okay, so that's good to hear that you're expecting a pickup in urban consumption that could benefit areas like QSR as well. Arnab, but the other problem that some of the companies have flagged off that they're grappling with, Dabur, for example, is the change in the channel mix, with quick commerce now playing a bigger part, and we saw their update on what's happening with general trade, etc. How disruptive is this? Is this a specific issue only for some companies? And how do you see this, impacting demand and just the offtake over the course of this year?
Yeah. So quick commerce, if you really think of it fundamentally, is a new channel. How to think about any new channel is that you have modern trade, you have the conventional e-commerce, and you have quick commerce. Unlike conventional e-commerce, which has an endless aisle, and therefore the amount of options you can give to the consumer is infinite, quick commerce is still a dark store model. So you have a limited space for SKUs. And therefore, we believe quick commerce fundamentally will not shift market shares in the industry dramatically in most categories. There could be specific segments where there's a lot of new entrants, let's say beauty categories, where there could be slight fragmentation of market share. But otherwise, quick commerce is more in terms of most categories would be stable market share. The challenge that Dabur and some other companies you mentioned had highlighted was about inventory. So because quick commerce as a channel doesn't keep any inventory, while your physical retail channel keeps anywhere between 6 to 8 weeks of inventory. As the business shifts to quick commerce, there's a bit of a destocking, and that affects primary sales for a few quarters. We think it's a transitionary impact, and the impact is not very large in any case. Our expectation is anywhere between 50 to 100 bips impact because of this transition. But even that is a transitionary impact and something that's not very material for most companies to worry about.
Okay, all right, Arnab, that's a good context to keep in mind. Thank you very much for joining in today. We look forward to a longer conversation, perhaps after another couple of weeks. Thanks for joining in. That's the Goldman Sachs view on consumer expecting a pickup in urban demand going forward. The pre-open has settled and the cut is 236 points on the Nifty. We have now Nimesh joining in with the standout brokerage call of the morning. Which one is it, Nimesh?
I said, today it's an interesting report from Morgan Stanley today on the financials, and within that, they've upgraded AB Capital to overweight from equal weight. They've retained a target price of 247, a good potential 40% plus upside from current levels. Now, the stock is down almost 24% in the last 3 months and has underperformed the sensex. So that's been the key reason there. They are forecasting between FY24 to FY27 an AUM CAGR of 20%, EPS CAGR of 18%, and that would result into an ROE of 15% plus in FY27 for the NBFC business. Now, the company has got a strong, funding access because of the parentage, and they've managed the asset quality pretty well so far. At the current price, the NBFC is valued at just 0.9 times price to book. That itself is a sufficient cushion for margin of safety as well as potential upside. So on back of all this, an upgrade on AB Capital. Reversely, they've downgraded PB Fintech to underweight from equal weight. They have a target price of 1,400 rupees, which means a significant downside even from current levels. The stock has actually rallied pretty hard in FY24, up to 165%, and has been a massive outperformer. The downgrade is essentially because of...
Yeah. Nimesh, we'll just come back to you. Markets have opened. So let me just quickly address that. Thank you for that. We've got the opening rates on your screen. Nifty is down 200 points. So 23,220. The Nifty Bank is on your screen. It's down about 1%, 48,270. You've got the sensex, which is down about 1%. The IT index is down 0.5%. So yeah, it's a clean 200-point knock. Look at the Nifty heat map. Tells you the story. Only 2 in the green, 1 unchanged, and everything else in the red. Surabhi.
Okay, let's talk about where the hits are coming in. The weakest names on the Nifty include BPCL, BEL. Actually, let me just go over the oil trade before I look at the rest of the Nifty, because that's where it's playing out. Your BPCL, HPCL, IOC, these stocks are down. HPCL is down, by the way, as much as 6%. That's the extent of the impact that's playing out today. BPCL is down about 2.5%. IOC is down about 3.5%. Now look at the tire companies, CAD, JK Tire. These stocks are down about 1 to 2%. And some of the paint companies like Berger, Indigo, Kansai, Nerolac, these are all down about 0.5%. The impact is not so much on paints actually. It's far more pronounced on the oil marketing companies this morning. Aside of this, PSUs as a space, they were reeling under pressure last week. That is continuing this morning. Look at Power Grid, look at NTPC. So more names on the downside. Coal India as well. SBI Life, SBI itself is down, which also brings me to the Bank Nifty. Bank Nifty is down in step with the Nifty. Cut off around 500 points on the Nifty Bank at this point in time. Almost everything on the Nifty is down really. There's nothing on the way up. TCS is the Lone Ranger. It's struggling at the flat line. IndusInd Bank, thanks to the MSCI impact and the change in the shareholding, is up about 1.5%. IT is trying very hard. Most of these stocks are close to the flat line or down only about 0.25%, but it's tough to say the least.
All right. Well, in terms of beneficiaries from that oil price spike, Oil India, that's a stock that we mentioned today. It could be one of the stocks you look at. That one's up close to 3%. So big up move is what we're seeing on that one. Kalyan Jewellers, from last Monday to this Monday, from the highs that we saw last week, the stock has corrected 20%. That's the kind of selling that we've seen on this name. Valuation-wise, things went, ahead of itself, it seems so. And from the top, the stock has corrected big time. So continues to reel under pressure. Yields have moved up. That's not very, very favorable for some of these new age companies. Paytm is down close to 4.5%. So that's seeing intense selling pressure. You have Zomato that's down. Nykaa as well, that's down in today's trading session. So big moves is what you're seeing on these names on the downside. AB Capital, as Nimesh told us, that brokerage upgrade that's come about. So that explains why that stock is up and about. PCBL, the stock that had a one-way run in the last year. I think it came out with a set of numbers. And PCBL is now down close to 8.5%. So big down move is what you're seeing on that one. Adani Wilmar is down another 7.5% in trade today. And BHAL is well down 3.5%. So the headline index is down 230 points. The problem is in the broader markets. Only 270 stocks are advancing for close to around 1,900 stocks that are declining. Prashant.
Oh, absolutely. I mean, I think it's a in a way easy market to cover because you can kind of brush it off and say everything down, right? And everything is down. 10:1 in favor of declines. If you just sort of want to count the number of stocks which are down as against the number of stocks which are high right now. So we'll get back to some of these individual names, but there is damage, rest assured, across the board in varying degrees. Sanjay Mokim is our market master of the day, strategist, head of India Equity Research, JP Morgan India, and he's with us. Sanjay, good morning. Great to have you with us here on the program. It's always a pleasure. Prashant this side. Sanjay, the first, two-part question. One, do you think, we all know it's bad out there, it's obvious, it's all, and we're seeing it around the world, but the market here in India in rupee terms is already down about 11%. And I think after today's fall, about 11-12% from the highs. Consumption has been weak since the second quarter. Earnings growth, etc. Markets are essentially forward-looking animals, right? It's not about where things are now, but where things will be, say, 6-12 months out. So in that sense, put the markets in context to what we are seeing in terms of news flow and macros right now. Go on.
Good morning. Great to be on. I think there's two things which are driving the to term it in this terms, excitement in the market. One, of course, is global uncertainty. You've seen VIX indices going up everywhere. US bond yields are almost in touch of 5%. And that's a reflection of the uncertainty on the change in policy in the US, whether you get rate cuts or not, what actions are taken by the new Trump administration. And whether we like it or not, these do have implications for Indian equity markets. As a measure, momentum stocks or momentum as a style is doing poorly almost everywhere. High duration, growthy stocks are doing badly. So that does have a rub-off in India. And to your point, Prashant, how does this play out? This is very binary, right? It depends a lot on what action is taken once the new administration is in place. But call it 6 months from now, we will have a fair view on what is happening, right? What is affected, what changes are made, and the implications of that. Right now, we're living in uncertainty. The second, which is a more domestic phenomena, is earnings momentum, which was very strong in 23 and early 24, but now has actually come off quite a bit. And we don't expect that to change too much. We think, yes, it will get a little better from where it will be in December. Purely on base effects, the June quarter should start to look a little bit more better. But I would argue that we are in for a period where it becomes a little bit more nuanced. Everything goes up rally is probably at an end.
Sanjay, hi. Morning. Tough morning, really. I was now, on days like this, you start extrapolating back and see when was the last low and all. And I just realized that we've broken our November lows. And now I don't know. I mean, the chartists were talking about it. I remember one chartist made this point that we could retest the lows that were made on the day when we got the general election result. That, 1,100 point swing down and then the rebound. And that was around 21,200 thereabouts. So who knows? But the problem is, Sanjay, that it's turning out to be a bit of a perfect storm. You have all these global issues, Fed rate cuts, tariffs in the US, uncertainty of policy, as you said. And then we have local issues in terms of the earnings trajectory. So let's talk about your assessment there. Whether this slowdown is transient. We were just speaking to an FMCG analyst at Goldman Sachs just before the call with you. They, for instance, are hopeful of a recovery on urban consumption. Where are you when it comes to earnings this year?
Well, we're all hopeful of some sort of recovery. The December quarter doesn't look that well placed, to be honest. Our base case estimate is for low single-digit earnings growth for the Nifty. But more worryingly, what happens the December quarter typically is full of downgrades, right? You typically see large earnings cuts, and that's because analysts catch up to their full year forecast once the 9 months are over. So I don't think the momentum will change too much. But more fundamentally, what you should start to see, hopefully, is the impact of the rains that we saw last year and good monsoon spread showing up in rural incomes, at least partly as the harvest rolls through. So there is hope that you should start to see a little bit of an improvement in the mass market consumer outcomes. But again, we've been crying wolf on this for so long that I think only once we get it will we have any bit of visibility.
Just to clarify on the earnings numbers, Sanjay, you said single-digit earnings for Q3 or was it FY25?
So Q3 we expect single-digit earnings growth, but for 25 we think we'll get around 10-11% EPS growth.
Or 10 to 11%. And too early maybe to ask you, but do you have some numbers for FY26 as well, as of now, from where we stand?
Sorry, I meant CY25, 11%, that's roughly.
Okay. So 11 to 12% for CY25. That's the earnings trajectory.
That's right.
Got that. Thank you.
Which recovers to mid-teens in 2026? That's what you're working with?
Well, I think it's a bit too early. When I say CY25, it's effectively FY26. I think we haven't gotten as far as forecasting FY27 yet.
Got it. All right, Sanjay, but weakness like this gives you a good opportunity to get into stocks that you could be, bullish on and prospects look good. Could you, name a couple of themes? I recall in the past we've spoken about the real estate space, that had the momentum. That's done quite well as well. Staples, they've been underperformers, but maybe under-owned as well. What do you like at current reckoning, the top two themes?
Well, we like real estate, we like the power sector, we like financials structurally because, look, that's the one space where you get a combination of decent valuations and hopefully good long-term dynamics. We currently are underweight materials and some select consumerish names, perhaps. But I think, look, if you try and say that, look, this correction is providing me opportunity, that's effectively a call on valuation, right? Where have valuations become reasonable? And if you use that filter, unfortunately, it's only the financials that pop up even today.
Mm-hmm. But Sanjay, the financials actually, though the valuations look very yummy, you look at that ratio of banks and IT, and that's gone to the extreme that we've seen in multiple years because IT has done very, very well, while the Nifty Bank has underperformed to such a large extent. Though valuations are attractive, it seems the selling pressure continues out there. But do you believe it's come to that juncture? Well, now, in fact, you need to start loading into some of these financials because some of them are trading at valuations that we saw even 3-4 years ago.
Well, if you take that same chart, the banks versus IT, and extend it to a longer period of time, take let's say a 10 or a 15-year chart of banks versus IT, you'll see you come to a very different conclusion, to be honest. Right?
Indeed.
Banks have outperformed IT for a very structural basis, and that's how it should be. It's a domestically facing business versus something that is facing an external environment. And I don't know about the timing, whether now is the time or not, but on a valuation differential, it does look compelling.
Real estate, financials, power, underweighted materials, and select consumer stocks. I mean, that's basically broadly the view which is coming in. Sanjay, is it just with the budget around the corner, right? Any thoughts out there? Will the budget can the budget be a little market friendly, or do you think it's unlikely? There was an election recently, so what's really the need? And the problem though is, while the slowdown is older than all this global recent stuff, any help has to be done in this global context, and the global context is a little adversarial. So what's your sense, Sanjay?
Well, I'd say, look, we are entering a sort of slightly different sort of dynamics for the government. For the last 3 odd years, we were in a period where revenue growth was very, very strong and subsidy bills were well contained. This is the first time where you're seeing some pressure on revenue. And remember, for FY25, we've had a very strong dividend from the RBI, right? And that may or may not be repeated next year, we'll see. But you are looking at a situation where the government will have to be careful about its revenue projections, whereas subsidies, let's say, on food or on LPG are going to exceed estimates after many, many years. So you're getting into an environment where, again, you have to make choices, where there are constraints popping up. And as a result, the broader theme is, let's not expect any major sort of stimulus, because my guess is the government will want to stay on its path of fiscal consolidation. And if not fully to 4.5, they would want to bring deficits down a little bit further in the next budget as well. So you can look at minor changes, but I don't think we're in a situation which calls for a major dilution of the deficit target.
That's interesting, Sanjay. So in that 11 to 12% earnings projection, you're not expecting or baking in any major fiscal bonanza. Let's talk about monetary. I mean, the world over, the trade is now coming down to the reality and realization that the Fed will not be very charitable this year. Let's talk about what you're expecting on the monetary side, because, I mean, earlier the market was expecting the whole rate cut cycle to start in India. But I'm wondering, with crude oil prices elevated 5%, rupee doing its own thing, I don't know how charitable the RBI can be. What's your expectation there?
Well, there's two facets to it. One, we still pencil in a couple of rate cuts from the RBI for this year. But your point is very valid. It will depend a lot on how the external environment shapes up. If you get tariffs and EM currencies start to move in response to the tariffs that are imposed, then you will have pressure possibly on the Indian rupee as well, and that will change the outlook for what the RBI can do on local rates. The second measure is the control on credit flow, on liquidity as well. And maybe the RBI can be a little bit more generous, and all the measures that have been put in to constrain lending could have been pulled back. But do we see an environment where the RBI brings in too much of surplus liquidity? Probably not just yet. We will, again, to your point, it depends a lot on how the external environment shapes up.
All right, Sanjay, appreciate you joining in. Thanks a lot for joining in. Looking forward to having more chats with you in 2025. The screen is looking a little bit jittery, but sometimes there are plenty of opportunities that do crop up. Just one point before we move on. Wanted to pull up the advance decline ratio. When we started our trade, around 250 stocks were advancing. That number has gone to around 450. So there is some kind of buying from the broader markets as well. Big underperformance is what we've seen, but at least the number of stocks advancing has mildly gone up by around 150 to around 200 stocks. That said, let's focus on earnings yet again. IRDA is the next management on the show. The company, in fact, did report their numbers. The stock saw a sharp drawdown in Friday's trading session. However, today it's bouncing back. The Q3 earnings witnessed a sharp improvement in spreads. The problem was on asset quality. To discuss this and more, we're joined by Mr. Pradeep Kumar Das, the Chairman and Managing Director of the company. Hi, Mr. Das. Good morning, and thanks a lot for joining in. Tell us about the asset quality. There appears to be pain in asset quality. Was there any one-offs? And if you could give us a guidance from here on in terms of your asset quality numbers.
Yeah, very good morning, and thank you for inviting me here. See, our gross NPA and net NPA has slightly gone up, and you see that is in a particular group's account, some 433 crore. But this is just NPA figure gone up. It is not that write-off we have considered anything like that. And you see that belongs to that waste to energy and bioenergy category. In our total loan portfolio, you see hardly 1% of our loan portfolio is having that kind of assets. So therefore, we do not foresee much problem in that. And this has just become NPA now, and the group is working on it. And they are taking certain other measures to how to come out from NPA. And we are quite confident in the time to come that also can be translated into a not NPA account. And if you see total net NPA, that is around 1.5, and when our book size is 69,000 crore roughly, and in which 80% of the assets are from traditional area and 20% from emerging area, where the new and emerging technology and challenges, all policies, everything is there. Despite that, we have maintained. And also, 76% books is with private sector and 24% with government sector. Despite having 76% and despite having 20% emerging, our account is that. And if you look at this SMA category of assets, hardly 6% is coming under SMA. And largely those are coming from traditional area, and by and large those are coming nowadays because of the little time, cycle time of the realization of those developers from the customers is slightly increased. But however, those have not impacted NPA at all so far. So therefore, we are confident in the time to come to happen. And if you look at that particular group's account, and they had perfect tie-up of the raw material as well as for the off-taker agreement and all. Only COVID and post-COVID, their project management impacted a bit, and I'm sure the group is taking all kind of measures to again look into how the account can become not.
Okay, all right, Mr. Das, let's come to the numbers since you just mentioned net NPAs at around 1.5% and gross NPAs around 2.7%. Going ahead, what do you see these numbers cool off to? And also help us out with what are the slippages number, the write-offs number for the past quarter? Please go ahead, sir.
So, as I said, only 433 crore new NPA has been added. And as far as going ahead, we are confident this number is going to come down. If you see last almost 18 quarters, we had been reducing the NPA gradually, and not by just settling with any kind of haircuts and all. By and large, mostly, I think in more than 95% of our NPA account, wherever we have gone for settlement, we have either realized the principal cost of funds or principal on simple interest or principal cost of loss and certain fair amount of margin there. So that was their approach to settle the account in last 18 quarters. And 18 quarters continuously reduction was happening. Only this quarter, because of one account, it has gone up, one group's account. And we are quite confident that this, to come by March, will again work out to bring down the NPA.
Okay, slippages and write-offs in the past quarter, you want to give us that number?
See, these slippages, what has happened now also, these are pertaining to prior to 2020 sanctions and all. And if you see last 4 or 5 years, whatever sanction we have done or disbursement we have done, we do not have any major NPA or slippages. So therefore, I do not foresee that any kind of major slippages in the March or in the time to come.
Okay, so now that we've understood the asset quality picture, so let's talk about both the outlook for disbursals and also margins. I mean, your margins in the reported numbers are actually looking very steady, 3.3%. What is the funding environment like, and what is the expectation that you have?
We have been focusing on between 3 to 3.5. As our name speaks, the developmental agency, Renewable Energy Developmental Agency. So our object, and being the sole arm of New and Renewable Energy Ministry, our focus is to develop the sector. And we have been focusing fair amount of margin, that 3 to 3.5. And our NIM is always range bound if you see continuously and consistently. See, we have the opportunity to enhance the rate in emerging sector, which probably a kind of fair amount of monopoly. It's not exactly monopoly, but at least we are the first choice by the developer to look at when it is new and emerging. But there, what happens if we enhance the rate, we'll have a better margin. Sorry. But what will happen, the project which is becoming bankable, they may not become bankable. That is the prime responsibility to us. And when we have a 500 gigawatt target and already 205 has been achieved, and if you see RE only, I'm taking out nuclear, 485 is to be done. So another 280 is going to be added. And fair amount of business opportunities there if we work with a disciplined approach. And the way we have exhibited in last 4.5 years, rather I will say last 37 years, particularly last 4.5 years, and I'm quite confident our business is going to continue to have that kind of steady growth. You look at our sanction has gone up more than 100%. And disbursement, profit, or any kind of figure, if you see, it is always in the 30 plus and around. So that kind of continuous and consecutive growth, what we are showing, that speaks about robust due diligence process and robust project review monitoring and catching the early warning signals also.
No, sir, exactly. Absolutely. I mean, no taking away from it. Even this time, your AUM growth is very solid, 36% year on year. Just looking for the number for FY25, what will be the AUM growth? And if you could just give us a margin range as well for the year as a whole.
You are asking for FY25. We have given up to 2030.
Yeah, I mean, in the near term, just to understand, in the near term, that's the long-term, picture. In the near term, what are the sort of levels that your shareholders can look out for?
Roughly what we have given to Government of India and signed MOU with them, around 29 to 30,000 we are going to disburse. Already 18,000 we have crossed. So, see, if you look at 4 years back, we used to do only 8,500 crores of disbursement in a year. And we have now, last year we have done around 25,000 crores. So this time we have an internal target much more than that, but at least with the Government of India, what we have signed, that is around 29 to 30,000 crores. So definitely we are confident of looking into that kind of figures. And as far as NIM is concerned, if you see our borrowing cost has been reduced. If you do the year-on-year comparison, we have improvised on our borrowing cost.
No, got that. And we saw that, Mr. Das. No, it's been, yeah, sorry, please.
And the way forward, we are again looking into various options, both domestic as well as overseas lending now. We want to reduce further. Yeah, and again, we hope in this budget we get that 54EC recognition. That will further help us to reduce our borrowing cost. And we are quite confident of further reducing the borrowing cost, if not sustaining that. Second, we have a fair amount of pipeline of sanctions with us. And since government has already bidded almost 50 gigawatt and 42% of that has already been PPA signed. And normally, when we do the appraisal and due diligence, we look into PPA signing conditions and all. If you take out that, then say 12 to 13 gigawatt, out of 50 gigawatt, if you take 42%, already 18 gigawatt has already been done. And last year's installed capacity addition is 18 gigawatt. So fair amount of business is there, and we are quite confident to reach the figures what we have planned.
Mr. Das, no, very well explained. Just one last question before we wrap up. Prashant this side, and good to see you, sir. I remember there was an approval which had come in to set up a different wholly owned subsidiary to venture into retail lending. Where is that at?
We have already received the consent from DIPAM and the ministry, and we have already submitted a request to RBI. And that is in process, and we are expecting maybe in a couple of months. I cannot tell the exact figure because it is RBI who is the regulator, so it will not be appropriate to talk something which is in their domain. So we are expecting, because they have asked us to submit the business plan and all, we have already submitted them, and we believe that by this year end or beginning of the new FY, we can be in a position to start that activity. See, we want to go slow but steady in that area, because lending a project loan and lending a retail loan is completely altogether different ballgame. So we have to do that.
No, absolutely, but that will also help in diversifying the overall portfolio. Important
more
in that sense.
importantly, because since we are coming out with QIP shortly, so we need to be cautious in all fronts and would not want to lose the investor confidence. And if you see our public shareholders, they are having 21% holding since beginning to till now also.
Okay. QIP by when, sir? This quarter?
This quarter we are targeting.
All right. We'll leave it there. Thank you very much for joining us. Appreciate it very much here on CNBC-TV18. And good luck. Good conversation, detailed conversation with you as always. We'll take a quick commercial break here. We'll come back, and it's going to be real diamonds versus lab-grown diamonds. We have Senco Gold Management. We have Goldium International both joining in to talk to us about it. Manisha will be here as well to set the context up for us. So stay tuned. Interesting conversation next.
All right, welcome back. Well, let's straight away get to that discussion on lab-grown diamonds, which have been giving quite a competition to, of course, natural diamonds. We first have Manisha joining in to set the context for us, because the fight is real. The brands are really sort of, stepping up the heat. So, Manisha, what do the numbers tell us in terms of whether it's price action or demand?
Well, it's both, and I'll take you through both. But let me tell you, set the context first, because even now, when you step out, people are still asking on what are lab-growns and whether they are real diamonds or not. So just let me put this out for you. When you look at the natural diamonds, well, they are formed 150 to 200 kilometers below the Earth's crust, and it's 1 to 3 billions ago is how much time it takes to form a diamond. When it comes to the lab-grown diamonds, well, as it suggests, it is formed in a lab, but they chemically, physically, and optically match the natural diamonds in a lot of ways. And then there are simulated or fake diamonds, which clearly falls in category of cubic zirconia or moissanite for that factor. So that is telling you that there are 3 types of diamonds in the markets there. When it comes to lab-grown diamonds, well, there is certification as it happens in natural diamonds, and it happens on all the major C's, which is cut, color, clarity, and caratage as well. And when lab-grown diamonds also are of 2 types, and that's important to understand that as well. One is CVD, which we seem to be making the most in India. Actually, when you look at the lab-grown diamonds overall, the world, 25% of that contribution also comes in from India. So just taking you through the sides then, CVD is chemical vapor deposition, that is the full form, and the method was created in 1980. So this is clearly not a very recent phenomena. Apart from CVD, the other method of creating lab-grown diamonds is HPHT, which is high pressure, high temperature. This technique also was created in 1950. So even before CVDs came in, but it only has started to pick up now in the markets there. I also quickly want to take you on how these diamonds are created. Well, for CVDs, the diamond seed is placed in a vacuum chamber. It's filled with carbon-rich gases and then heated up to 1500 degrees. And then when it comes to HPHT, well, in this case as well, the diamond seed is placed in a carbon exposed area, and 2000 degrees of Fahrenheit temperature is put in, and 1.5 psi pressure also is put in there. So these are 2 ways of making lab-grown diamonds. CVD is done in India, HPHT in other parts of the world. China clearly leading when it comes to HPHT there. Now let me take you through the numbers then. And this is what the international lab-grown markets look like. 2023, the market size was 22.8 billion. 2024, it has increased to 25.89 billion. And when you look at 2010 or 11, it was about 5 to 11 billion. So we have seen market almost double in the last 10 years. Indian lab-grown market is a small part of that at around 2.7 billion. But the important discussion that you are going to do today is the lab-grown jewelry market, and that in the Indian concept also seems to be increasing. So last year was $264 million. 2024 was $299 or almost $300 million there. So we have seen the market continue to grow onto that one as well. And now even more important is that the Indian government has been pushing for lab-grown. They also abolished 5% tax on diamond seeds. They also have initiated research and development. And also export promotion and marketing accessibility is something that the Indian government has pushed for. The reason that you have seen lab-grown diamonds see so much adaptability, one is because you have seen affordability. Of course, they are cheaper in prices. They can be bigger in sizes. They are certified. There's quality creation. And many people tell us that people walk up to them and want custom-made diamonds. And that is something that the lab-growns can do for you. And finally, it's beyond jewelry as well. Jewelry is just one part of it. The lab-growns are used in electronics, cutting tools, and thermal conductors as well. And the last plate should now come in on your screens. And that tells you on why the lab-grown is so, accepted and bought as well. So if you were buying, and these are very approximate numbers, I mean, your guests will tell you on what the exact prices are. But 1 carat of natural solitaire price is 7 lakh, and lab-grown at the same 1 carat solitaire comes in for 65,000 rupees. So there are more people going in for this. Naked eye cannot say whether it is lab-grown or naturals. And of course, sustainability is another part of it. But this is the major reason that you have seen such huge adoption for lab-growns.
By the way, Manisha, the way you explained the manufacturing process, I was thinking whether I could set up a small unit.
There are, 7,000 to 8,000 reactors right now. So there are that many people right now producing it. So
7 to 8,000 producers?
Reactors. So these are the machines that produce diamonds.
So you need
a reactor. You need to get a diamond seed, you put it in, and depending on the size of your machine, it can grow larger in that sense. So whether you can grow a 1 carat or 3 carat or a 5 carat or 30 carats. So that is the investment.
I know where you're going.
Yeah.
Forget growing vegetables and plants and,
We're growing diamonds now.
Growing diamonds. It's that, that time. But Nigel?
Well, let's get our guest in. Then we have Mr. Subankar Sen, the Managing Director and CEO at Senco Gold. and Anmol Bansali, the Managing Director at Goldium International, who joins in. Hi, Suvankar, as well as Anmol. Good morning, and thanks a lot for joining in. Suvankar, you go first. Tell us, what is your experience on ground? The question is lab-grown eating into the natural diamond market? Could you tell us what is, your take on this front? And what is the pressure on lab-grown diamonds as well? I believe prices have come down dramatically. Give us a number.
So, what we are seeing is that the awareness level about the differentiation between diamonds and natural diamonds and lab-grown is gradually, the consumer is getting aware. While we have opened 4 stores of lab-grown diamond jewelry in the brand name of sensex, we are seeing that consumers are coming, inquiring. There is a lot of curiosity about what exactly it is, and it is our responsibility as a jeweler to build that awareness amongst the consumer base. So that is one level of understanding that we are seeing. The second is that the young consumers, they are also extremely excited about the lab-grown diamond jewelry because it makes it more affordable. And, we need to understand that diamond jewelry as a share of the pie of the whole jewelry industry is about 15 to 20%. But by lab-grown diamond becoming a part of the whole jewelry portfolio, the probability of people buying studded jewelry and studded products can go up to a large extent. So more and more people on a day-to-day wear basis can buy lab-grown diamond jewelry. But at the same time, we are realizing one thing, that when it comes to the special occasions, weddings, something which is to do with emotions, people are quite conscious that, yes, they would want to give natural diamonds, it comes to proposal or that memorable moment. But yes, when it comes to fashion, when it comes to kind of, the various changing scenario of trends and the various shapes of diamonds, I think people are trying out with the various shapes of diamonds with lab-grown. So that's the ground level scenario. This financial year, if you really look at it, in terms of the growth in the diamond industry, we have seen that the growth of natural diamonds have been a little limited. Marginal growth has happened, but when it comes to the lab-grown diamond industry, since the base is extremely low and it is building up, the growth rates are much higher. So that's the way it is. More and more stores are coming up. Consumers are trying out as a new product. And I think that the way we have gold, diamond, silver, platinum, lab-grown diamonds over a period of time will have a large chunk in terms of the wallet share of the consumers when it comes to buying jewelry. So that's what we are seeing at the ground. And as far as the pricing is concerned, that you said, that yes, in the last 1 year or so, we have seen a drastic, fall in the pricing. That is also led by the fact that there has been an overtly production and the supply has been very high. So the demand is yet to pick up to the extent that the supply has been. And we have seen about a 25-30% price fall in the lab-grown diamonds as well. But I guess that time is such that now it is almost the price of the labor of cutting and polishing the diamonds, and the prices are more or less stable. And I don't see much of price fall happening from what we are seeing right now. So this is how is the ground level feedback from my side.
But natural diamond prices as well have seen pressure, right? So
yes,
if you could give us a percentage, how much is that corrected by?
So the natural diamonds, when it comes to the pointers, upwards and solitaires, there we have seen that, it's not just because of the Indian demand, but globally in the US, in China, there has been a slowdown, and the prices have corrected back to the 2008, 2009 levels. But that is only in the bigger size diamonds. But when it comes to the smaller size, -11, there we have seen a very marginal dip in the prices of 5-7%. It's in the bigger size that we've seen a 20-30% dip in the pricing of the natural diamonds.
Okay. If I could just sort of come in over there and get to Anmol Bansali as well, Managing Director at Goldium International. And I mean, as a lady, if I could weigh in, I think what we're also undergoing, and correct me if I'm wrong, gentlemen, I think what we're also undergoing is a shift in the mindset. The fact that consumers are not really looking at diamonds as a store of value anymore. I think that message has been driven home, that you can look at pure gold as a store of value, that too in a different format, maybe not necessarily gold jewelry because there are a lot of charges involved, but gold, yes, maybe not diamonds. And perhaps diamonds are now being looked at more as, your lifestyle, consumption, rewarding yourself. And therefore, that could be perhaps triggering a switch towards lab-grown as well. But you come in on this, Anmol. What is the increase in adoption that you're seeing? And this reduction in prices, the volatility in prices of both natural and lab-grown, is that making people hesitant, or is that not having an impact at all?
Thank you, Surbi, and thank you for having me. As a summary, Goldiam is a diamond-studded jewelry manufacturer and exporter. So, erstwhile, up until 2 months ago, when our B2C brand in India launched, we were 100% export, focusing on the US consumer market. Within that, we've seen a sea change in demand from natural diamonds to lab-grown diamonds. About 4 years ago, lab-grown diamond jewelry used to be less than 10% of Goldiam's revenue. Today, in our latest quarters, it's north of 70, and we see this trend increasing, especially in the US, as the average consumer now has complete awareness of lab-grown diamonds and has moved his and her buying pattern into this segment. Regarding the prices, as Mr. Sen said as well, they've certainly come off as supply came on in a huge manner in the last few years. However, given today's prices, where really most of the cost of the gemstone is now in the labor associated with cutting and polishing it, we are very confident that in commercial sizes, which is 1, 2, 3 carat diamond sizes, we don't see much price erosion coming in the future in lab-grown diamond prices. At today's prices, we find these rates to be a true base from where our focus should be on volume growth instead of just value growth.
All right. Gentlemen, good morning. Prashant here, Suvankar and Anmol. So from an investor's point of view, right, let me ask you guys this. Suvankar, for traditional gold and diamond companies, right, does it make sense to, if as and when they start manufacturing, this is not just about you, but I mean others in the industry as well, does it make sense to do lab-grown diamonds in-house or buy it from a player like Goldiam and brand it under your own brand and sell it?
So if you ask me currently, I think with the supply and the manufacturing that they are doing in a specialized way, it makes more sense for us to get it from players like Goldiam and then brand it, have our own designs that we are creating and then get it manufactured. So even when it comes to diamonds, for that matter, we are manufacturing the jewelry, but the sources of diamonds is coming from those who are cutting and polishing diamonds. Similarly, it is players like Goldiam who are creating and manufacturing of lab-grown diamonds. They are the ones who are going to supply the diamonds, and we are the ones who are going to manufacture the jewelry with our designs. So that's the way to look at it.
Okay, at least now, right? I mean, right now.
Yes.
Anmol, could you tell us what is the cost of setting up a lab-grown diamond unit? Capital cost? I mean, is the entry barrier high, or is it not really that tough? Go on.
Sure, Prashant. Thanks for the question. Just wanted to clarify, even at Goldiam, while we do have our own diamond growing plant, most, which is over 80 to 85% of what we sell in terms of finished jewelry to our export markets, as well as in our B2C brand Origem in India, over 80% of the diamonds are purchased by us from third-party growers in Surat, Jaipur, etc. So while we do, yes, have our own diamond growing plant within Goldiam, a predominant bulk of what we are selling is actually procured from third-party sources. Today, given where prices are, of course, a lot of machinery is now made in India as well. The approx cost to set up a CVD diamond growing plant would be around 1 to 1.2 crore per reactor, with ancillaries such as piping, gas work, etc. From that perspective, again, we're a largely pure play jewelry manufacturer. So for us, the focus again is similarly on designs, jewelry manufacturing and jewelry production, as well as strong sourcing to fuel in our jewelry requirements.
Right, and this 1.2 crores, right? I mean, so it's not that much in that sense.
That's correct. That's the reason for the supply bump as well in the last few years.
Yeah. So, I mean, so then for a player like, just again, from an investor point of view, and Goldiam, the stock has done phenomenally well. Is there a moat really, Anmol? Because, I mean, if there are tens of thousands of these units now, which come up for a market which is growing to supply it adequately, then what's the moat for Goldiam?
Absolutely. So for us, and we've been maintaining this for the past few years, distribution is our differentiation. to pure play grow diamonds today. In fact, where lab-grown diamond prices are, just the standalone business of growing diamonds really has no true return on equity or return on capital that's sizably available to offer to investors. It's when you forward integrate into jewelry. So 100% of diamonds grown at Goldiam are sold within our retail brand and within our wholesale network. When you sell to retailers, and now when we have launched Origem, when we've forward integrated into direct retail in India as well. So that entire end-to-end supply chain of growing diamonds is in-house at Goldiam. And we certainly believe that the moat is always in distribution. That's been our focus.
So far it is kind of B2B for you, right? Largely,
yes.
Anmol.
So
but you're starting retail as well. I mean, direct under your brand.
That's correct.
Yeah.
That's correct, Prashant. So 97% of our revenues today are B2B to the US large retailers. We've just about 2 months ago started our brand in India called Origem. We've launched 2 stores and we're looking forward to further growth here.
Yeah, no, absolutely. So sort of distribution and kind of, putting a brand on it, right? And not just the stones. Lab grown and otherwise, which is where the money is. This calls for a longer chat, but we're in the middle of the result season, so there is a lot of stuff to cover, a lot of ground to cover. So Vankar, thank you very much for joining us with your perspective. Anmol, great to have you with us here as well, and we'll have you guys back as we continue this conversation around the evolution as far as lab-grown diamonds are concerned. It's time for our special segment, Quarter Se Quarter Tak. We bring you earnings expectations from one sector every day. Today, it is the turn for oil and gas. Sudarshan is standing by. Sudarshan, good morning.
Morning, Prashant. So third quarter overall for oil and gas sector is expected to be relatively weak, while OMCs may outperform all the other companies because the stability combined with strong auto fuel demand and refining margins positions OMCs for a strong Q3 showing. However, city gas distributors such as IGL and MGL are set to face decline in margins and profitability due to cuts in APM gas prices. For Reliance Industries, we are expecting a steady growth, while for other gas companies, including GAIL and Petronet LNG, the outlook is going to be less optimistic. Flat or declining volumes combined with rising costs are expected to weigh on earnings. So some of things that we'll be watching out for. First, we'll monitor commentary on volume and margin strategies for city gas distributors and potential price hike announcements they might take. Second, updates on project progress for ONGC, HPCL and GAIL will also be crucial. For Reliance Industries, we'll see if there is any commentary regarding potential Jio IPO. Now, talking about the company-specific earnings, we'll start with Reliance Industries. We are expecting a steady growth in Q3 versus Q3 FY24, with consolidated EBITDA projected to grow 4% year-on-year and 9% sequentially. The Jio Telecom segment will be the key driver, benefiting from a tariff hike that company had taken in July 2024. This is expected to push Jio's EBITDA up by 8% sequentially, with a corresponding 7% rise in average revenue per user, or say ARPU. While the O2C segment may see a 4% YY decline in EBITDA, but sequentially it's expected to rise 9%. Retail EBITDA, meanwhile, is anticipated to grow modestly, rising 2% year-on-year and 9% sequentially. Now coming to upstream oil companies. ONGC and Oil India are seen reporting 6 to 8% growth in EBITDA year-on-year, with benefits of windfall tax removal are unlikely to be seen in Q3. On volume front, it's expected to remain weak for both Oil India and ONGC. Now moving to OMCs, or say downstream oil companies, OMCs are positioned for a strong showing in Q3, driven by favorable refining margins and auto fuel demand, while higher LPG inventory losses compared to Q2 may temper gains. Companies like HPCL are expected to show robust growth due to a weak base. Conversely, IOC's performance may be impacted by high base effect of Q3 FY24. Talking about city gas distributors, the unexpected cut in APM gas prices that government had announced will significantly impact CGDs, with EBITDA for both IGL and MGL are projected to fall by 37% and 24% sequentially, and for both IGL and MGL. Gujarat Gas, though, may buck the trend with industrial volume growth of 12% sequentially, helping offset some margin pressures that company might have seen. As for other gas companies, most of them are expected to report weak results for Q3 FY25. GAIL's EBITDA may decline by 7% sequentially, driven by weak marketing and petchem segments, although strong LPG performance could provide some support. For Petronet LPG, volumes are likely to remain flat, though marketing gains may surprise positively in Q3 FY25. GSPL is expected to report a 7% decline in EBITDA due to lower volumes and rising costs. So overall, for oil and gas sectors, it's expected to be a mixed Q3 FY25.
Okay, got that. Sudarshan, thanks very much for taking us through the expectations. By the way, these oil marketing companies, stocks are still really under pressure. HPCL, for instance, is down 6%, and this is on the latest. Sudarshan's talking about under recoveries for some of them in LPG, which, by the way, our colleague Sapna has been reporting that the government could look at somehow sort of neutralizing a bit of that impact. But if oil prices keep rising the way they are right now, that under recovery situation only gets worse. And those are the the reactions on the screen. We've got Dayanand Mittal, oil and gas research analyst at JM Financial, now joining in. Dayanand, great to have you with us. So we've got a broad construct which our colleague Sudarshan has just laid out. But you tell us, let's start with the positive news. In the entire oil and gas space, where could we see pleasant surprises? Which are the stocks that you would be relatively more optimistic on?
So from a quarter perspective, OMC's earnings is where we will see positive surprise after 2 quarters of 2 challenging quarters. But I think key focus from market perspective would be around current uptrend in oil price, where it stabilizes, particularly with Trump coming in from 20th, how there will be more clarity on what policies he will actually implement versus what he has been saying. And second would be on first Feb budget. 2 key takeaways that market would be focusing on would be whether and how much would be the compensation for OMC's LPG losses. Given the losses, it will be in the range of 35 to 40,000 crore in FY25, while the budgetary provision is around 11,900 crores. And if there's no hike in LPG price, let's say post Delhi election, then the 35-40,000 crore run rate will continue even next year. So that would be one key event market would be waiting for. Second, though with rising crude, this expectation would now get muted, but any chance of any hike in excise duty on petrol, diesel, that would be the second thing that market would be waiting for OMC. So quarter might be good, but outlook-wise, we remain cautious on OMCs. We prefer ONGC Oil India over OMCs, primarily because of our view that the crude price is likely to be supported around 70-75, driven by OPEX, a reasonably decent pricing power.
Okay. Fair point. We need to watch out for the way oil moves, because then these things could change very quickly in Q4 if oil prices continue their upward trajectory. On city gas distributors, that's the question, because the derating happened when we got to know that they'll get lesser APM gas. But since then, all the companies have made announcements, and it's not as bad. But now they're getting a slightly better share. Where are you on the city gas distributors, and what is the earnings hit that you are right now penciling in for not just Q3 but even Q4?
So the challenge there is more structural. Yes, this shocker came a bit was a negative surprise. So what would we have seen in terms of decline in APM allocation over 2 years, probably next 2 years? That happened in a matter of 2 months. So yeah, there was some reversal to it, but that's only about 20% of the cut that government had announced. So it's only a marginal relief. Our key reason for a negative view on IGL, MGL, and the CNG-dominated CGD companies is APM allocation, APM production by ONGC Oil India is on a declining trend. Government is gradually moving APM to new well gas, which will be priced at around $9. So gradually, CGD companies' APM allocation has to come down by about 7-8%, 10% every year, which would mean they need to hike CNG prices by 2-3 rupees per kg, which will gradually erode the differential or the competitiveness of CNG versus petrol, diesel. So yeah, structurally, we continue to remain negative on IGL, MGL. Yeah, this relief came as an incremental positive, but the structural challenges prevent us from taking a constructive view here. We rather prefer Gujarat Gas, which is more driven by industrial segment, and where our thought is spot LNG prices in the medium to long term should moderate with a lot of LNG supply capacity coming in globally, and this should help Gujarat Gas to restore its competitiveness versus propane in the medium to long term.
Okay, got it. So there are concerns there as well, and longer-term concerns. That's an interesting point you tell us that overall, production is on the decline from ONGC and Oil India itself. So, I mean, how much APM gas would be available anyway to allocate to these companies? Got that. Let's talk Reliance now. And again, I'm trying to pick on the silver lining here because the expectation is that refining margins have picked up.
Yeah.
Is that sustainable? What are you expecting for Reliance's oil and gas business?
Yeah, so Reliance Oil and Gas business, we expect the O2C EBITDA to be up about 10-11% QOQ, as you said, rightly because of uptrend in GRMs. GRMs for Reliance, we expect around $8.4 versus around $7.1 QOQ. GRMs have been weak in last 2 quarters, 1Q, 2Q, recovered in 3Q, but again starting to look a bit subdued in the current quarter till date. This is despite the winter in the western part of the globe being quite harsh this time, and hence which is supporting heating oil demand. So it's a bit surprising that GRM has started to weaken again, but our sense is GRM should be reasonably in a decent shape of around $6 per barrel. Singapore GRM for Reliance around $9.5, $10. Given the demand growth is likely to still outpace the capacity addition, because most private refiners globally are not setting up refining capacity given the threat of EV in terms of petrol diesel demand on the long term. So refining margin outlook should be quite reasonable, at least in the next 2-3 years.
All right. Thank you very much for joining us with that perspective. Appreciate it very much here on CNBC-TV18. That's oil and gas expectations as far as the third quarter is concerned. Markets have pulled back a little bit. We're down 185 points, 23,250 is where we are at. And the dollar rupee, I think, got to almost about 86.40 after opening at about 86.20 in the morning. So that's the other big one that we are watching. It's almost a 0.5% fall. That's big at this point. We'll get you more on this, but have to take a quick commercial break. We'll also put the focus on PB Fintech, sharp swoon, and then some recovery. Stay tuned.
Welcome back. Let's quickly go back to the market and address some stocks that are on the move. The market, by the way, it's pulled back a little bit. The opening cut was around 220, 230 points. From there, there's, I don't know, I don't want to call it recovery, but for what it's worth, 170 points lower. Stocks now. Biocon is on the move. Vinny earlier told us about some good news they've got on their Malaysia plant from the US FDA. Vinny.
So absolutely a positive news where a Malaysia plant, which is an important plant for the Biocon in terms of biosimilars and biologic side, they've received the US FDA approval given that it is a voluntary action indicated. Do not forget that this plant was inspected during September 2024. Before that, they'd also received an OAI that was official action indicated. Now this is a step up, and VAI is a positive news coming in for the Malaysia plant. What it indicates for Biocon now, there are 2 recent clearance coming in. One was the Bangalore biologics plant. So that is a positive, and now this is the second one. So all your regulatory hurdles seems to have been cleared up for a Biocon. Now this will pave way for potential launches that will coming in. That's the generic Aspat that is expected to get in an approval as well, and a launch in the near term. Other than that, there are a couple of drugs also they will be launching in the recent times, the biosimilars in the recent times. In Feb 25 they have one of them, and the other one also is going to be in the near term. Analysts are quite positive on this one. They've given it a thumbs up. Some analysts have highlighted the potential of generic Aspat for Biocon is almost at $25 million in FY26 and doubling in FY27 to $50 million. It's a $700 million market size as well. So a lot of potential in terms of growth that one could see coming in for the company.
All right, Vinny, got it. Thank you very much for that. It's macros moving the markets today. And when we come back after the break on It's the Economy, Lata today is going to be discussing all that's happening with US yields moving, the dollar moving, and Lata, the rupee now at last count, 86 or almost 40?
Yeah, almost 0.5% lower, sharpest fall in 2 years. Yeah. I have a very important global treasury head of HDFC Bank joining us, also an economist. So let's hear what they have to say.